Yeah.
All right. So I'll tell you, I'd created a very quick set of points to talk about. Maybe we just first agree on the points. I can add to them
Yeah.
if you tell me. Maybe a couple of minutes on just election stroke macro, because I
Yeah.
think it's the big news of the last quarter. A little bit on our performance, how we've managed through this period. Um, what are the winners and losers? They've really been mostly winners. What have they been? Um, how have we adjusted our portfolio in this period of time? So portfolio activity, what have we bought, what have we sold, which is really all historical.
Yeah.
A little bit on positioning. How are we positioning ourselves in our minds for this next year, let's say, short-term period? And within that, maybe cover sectoral views. What is cheap? What is close to being cheap? Where do we see some activity? Where is the research time being spent? Um, and then really open it up for questions. Is
Yeah.
that a reasonable
Yeah.
agenda?
Yes. Yes. Yes.
Okay. So let's kick off with just a few minutes on macro stroke elections. Really, the main macro in this recent period has been elections. Um, I think it's fair to say that this is actually a decent election outcome, but much worse than where people were 3 months ago. But the markets have seemingly not cared. In effect, a coalition government should be a less agile government than the previous 10 years that we've had. It is likely that we will see more noise in the political process, and that is an additional risk which the market, at least for now, is not thinking about, but could quickly be forced to think about when either Bihar or um, Andhra Pradesh create noise around their own demands, and the list of demands is long, right? So uh, there is. Can you hear me clearly,
Yeah.
Raghavendra?
Yes. 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 Okay.
There's something that's going on, bouncing on my screen, saying unable to secure connection.
No. So we are able to hear you.
Okay, all right. So I think the election outcome is clear. The election outcome on the markets is surprising, that the market is not actively thinking about the coalition risks, within which I think you have the budget. We started talking about that. The budget is the next main macro outcome for the country. You've got BJP now on the back foot, which will have to think about rural stroke poor a lot more. That has been the very, very clear message from this election outcome. There are many, many state elections, important ones in the near term, which more or less convinces many, me included, that this budget will be the first substantial policy outcome in favor of rural stroke poor. I think this government will still try very much to show that it is a pro-infrastructure, pro-growth government in terms of continuity, which means they may not cut expenditure on that front. So if you're going to increase expenditure on both fronts now, then you need more money. If you need more money, then either taxes have to go up or debt has to go up. Like I was saying, taxes going up, the simplest way to take taxes up would be to take sin taxes up. So cigarettes, be aware, don't buy ITC. If you have ITC, sell it. Anything that is sin tax, or I mean, any easy to pick up tax, we need to be careful, because the government will be looking for money to be able to fund its programs in this environment. That's one clear. Uh, if you think about how we are thinking about positioning, it's part of our positioning. It's a key outcome which we will be positioning towards. The remainder points through this next 9 months, I think the key election outcomes of the West are also due. It's an election year. You've got Europe in election mode right now. You've got a right-wing swing which is taking place over there. You've got November, which will be election risk full-fledged in the US. You've got a right-wing debate outcome, which has already taken place very recently, where the Dems have, Biden has, underperformed. Those have, those are further macro risks, which we will start talking about more and more in the coming months. And I think when I come back to Outlook at the end, what you're going to hear is you've got all these things that are happening. The positives were already in the price, and people are not thinking about the risks enough. So a cautionary outlook is what I will be really talking about. Okay, that was the little bit on macro. I can get more detailed into any of these topics if any of the listeners want to talk about it. I'm going to bring up just some numbers in terms of performance. Um, tell me when you can see it. Give me 1 second. Can you see my screen?
Yes.
Okay. So updated for June, performance numbers. We had a very good June. I was saying to Raghavendra before some of you joined that one of the substantial reasons why we hold cash is to be able to buy things when they correct. And on election day, you will remember that we had a very sharp reaction in the markets. The markets were down 6.5% for the day. Sensex, that is. And if you went to small cap, that was down about 10%. If you went to aggressive sectors like cap goods, that were down about 13%. Some of our names equally were down very sharply. Shriram Transport as an example. So we rushed in on that day and spent 8% of our cash, 8% of the portfolio. Our cash went down by 8% on that one single day. So all of that has really helped this 1 month return. We've outperformed Sensex. In fact, I think including small cap indices, etc., we've outperformed everything this month. On a 3 month basis, most of the performance is really this last month's performance, as you can tell from the numbers, 8.5 of the 10. And I think more generally, the point which I want to make is that our performance remains strong, substantially beating Sensex, while keeping risks well below Sensex. If you covered risk in terms of beta, our beta is about 0.5 as a portfolio against Sensex, much lower against any of the more aggressive indices. Even if you take the cash out of the portfolio and say, what is the beta of actual positions, it's 0.65, 0.66. So we are able to deliver, or so we have been able to deliver is more correct, a higher than market return with lower than market risk. And based on everything that I've been writing on the quarterlies, we have a view that risks are high in the market. Oh, the pricing is such that even small risks will impact the pricing of the market quite a lot. So we're very happy to say that the performance has been solid with very reasonable levels of risk that we've taken. Some more data. I think the things that you should see is that cash is down quite sharply from 35% 1 quarter ago to 21%. Largest component of this was used in on that one day, which is election day. But we've also increased our position in the insurance stocks, all the 3 insurance stocks that we own, which is SBI Life, HDFC Life, and IPRU Life. because they have become cheaper on a valuation basis. Performance of the underlying has been good. Some of the risks which people were thinking about, now the regulatory outcome is out, which is surrender values, etc., etc. And the pricing, which is it's a complicated multiple over there, embedded value based multiple, has become 20% cheaper than it was 1 year ago. So we like that. So if you think of the net cash usage, it has been election day, buying more of things on our portfolio. Second, by increasing life insurance from a 10% ownership towards a 15% ownership within the portfolio. And then we've got two new positions, which are one is a company called SJS. We put that on about 4 months ago, 3.5 months ago. SJS is a interesting company. It's an auto comp which is entirely focused on uh, what I'd call ancillaries. It's little printed bits that go onto two-wheelers and four-wheelers. So it benefits strongly from the increase in premiumization that's taking place in two-wheelers and four-wheelers in terms of the amount of premium content which is going into dashboards, into the vehicle exterior. So it's a very specific auto comp which we've added to benefit from the premiumization theme. We've added Yatharth Hospital, which you'll remember that we had very substantial ownership of Aster DM. It was one of our best winners in the small cap part, but it played out and we made that money. It was a 5x over a 3-year hold period. And we've been, even when as it was playing out, we were hunting for more hospital names to put on. We liked the space, hospital stroke diagnostics. We put one on this quarter, Yatharth Hospital, which is uh, three primary hospitals and two smaller hospitals. But the three primary hospitals are all Noida, and it's trading at a substantial discount to its peers, while its growth rate is substantially higher. So an example of what we call GARP, growth at reasonable price. So these were the two names added this quarter. We exited also two names which have been substantial winners for us. IOC, Indian Oil Corporation, which has done extremely well for us, was a bet we put on 2.5 years ago to benefit from crude price coming down, which happened. All the benefit came through on the balance sheet. And finally on the stock price, we took that. And the second name we exited was Manappuram, gold loan name. We were contrarian when we were backing gold loans because we had done a lot of private equity style work on the gold loan space to convince ourselves that the yields which had reduced from 22 to 16, 17 was a temporary phenomenon and only in one segment of the business, and that would go away over time. That happened. The companies did well, the stock prices did well. We sold. It's an entry at 90 and exit at 200 for us. So very good outcome. So that's some of the portfolio activity which has happened. In terms of some of the names that did really well for us this last quarter, Shriram Finance. It's been an incredible quarter based on very strong financials, but then also re-rating which has taken place on the name. And this was our biggest purchase on election day. So, not only has it done well, we also increased our position at the right time to benefit from it doing well. The move from 2,100 or so to almost 3,000 has happened practically since election day. So it's a very, very sharp move which has taken place on the name. HDFC Bank, it has been a loser for us in terms of our portfolio direction for the last 18 months. It has underperformed. It has done okay. Our entry prices started at 1,300. It's at 1,750. But again, bulk of the move has come in this last 30 days. Has done well for us at 1,750. We love it. If we were not an AIF and we were allowed to own more of this, we would have a much larger allocation. It's already at its highest allocation possible. We love it from here as well, from 1,700 as well. Other performers were Cipla. Cipla continues to be robust for us. Our purchase price 1 year ago was a great one at 900, And even from 1,200 a quarter ago to 1450, it's been a good performer. Again, a solid name which has performed for us. A name that came back and has been an underperformer on our portfolio for a year and a half, Imami. We had put this on as a beneficiary of its raw material margin normalizing. It had lost about 500 basis points in EBITDA margin when we put it on because raw material prices had skyrocketed. Benefited from raw material price normalization, but still the company's performance didn't do well because rural demand remained very weak, and the company and the sector actually gave back all the raw material benefits to consumers to keep market shares, etc. This last quarter, we saw rural demand already in actual financials of March 23, the quarter March 23. The numbers come out very good across the rural names, across most rural names, two-wheelers, rural-focused consumer companies, microfinance companies. All the rural play actually already started looking good. And then, based on this election result, the outcome is that there must be more rural-focused policy, which means that rural-focused names will benefit. Imami had done well for us already pre-election, and then post-election, it's gone up substantially. So we're talking about a move of 400 to 500 pre-election and from 500 to 750 post-election. So it's done really, really well for us. One of the names that we put on, SJS, the auto component company I was talking about, it's again, markets are moving so sharply right now that it's up 35% in this last quarter, even though we just put it on 4 months ago. So these have been some of the big movers on the portfolio which have done well and contributed to the numbers that you can see on the screen. Coming then to sort of the crystal ball, what is it that we see? What is it that we're thinking about? Where is the work going in terms of research to prepare for new names? We remain cautious on the markets. I think I'll repeat, I might have said this to Raghavendra before the call started. On election day, Sensex was down 6.5% on one day. Small cap index was down 11% on one day. Capital goods, as an example of the aggressive sectors, was down 13% on one day. It tells you how much fluff there is in valuations. So it is a market environment where many sectors are priced to perfection and many are even extremely expensive, which means that if there is any version of bad news, whether it be macro bad news, political bad news, geopolitical bad news, the reactions will be sharp. We're sitting on dry powder. We have 20% or so, and we will be looking forward to these sharp moves to benefit from them. That's how we are positioning. You do have a broader environment in which geopolitically China has become unavailable, which has caused a lot more global flows to India from a flow perspective. You do have an environment where retail investors are chasing after equities in India, which is causing a lot of flows, visible in SIP, but also visible outside SIP data. So there's very strong flows. So it is likely to be an environment. That's the point on flows. You have solid industrial and consumer demand, which is visible in company performance. So the flows are backed up with reasonable EPS growth. I would argue that the flows are even much higher than the actual reality of EPS growth, which is why you've got this overvaluation situation. But it is an environment where every little piece of bad news, given the very expensive valuations, would cause a sharp reaction, buying opportunity for us, and then normalization because the EPS growth is strong. So we're hoping for some more of these hiccups, budget, um, elections in some key countries, our own, policy environment over the next 6-12 months are all elements of risk on the valuations that we are currently seeing, which are very high. So that's the overall thought on positioning of how we are sort of positioning the book, within which thankfully there is a handful of sectors that is still offering outright value. One is lending financials. Lending financials, I mean primarily the large banks, HDFC Bank, Kotak Bank, even Axis Bank are still good buys at current levels, in our view. Um, Arguably, some NBFCs you could add to that lending financial list. We have increased our position in PNB Housing. We had a very substantial position in HDFC and PNB Housing as two housing finance companies prior to HDFC's merger. HDFC piece went away, which has meant we have taken PNB Housing up a little bit to increase our housing finance exposure. Housing finance, I think, is going to be a solid place. Housing finance and affordable housing finance are both going to be a strong place where we will see demand growth, especially in the next, as the next 12 months rolls on and interest rate cycles in the country soften. We've seen peak rates, and there's more likely for softening than there is for flattening of the curves, which in when they start softening, housing demand will get even stronger. Housing finance companies will do even better. Um, so lending financials remains a area where we see opportunity. Opportunity, and to be very specific, what I mean by opportunity, things that are cheap enough relative to the opportunity. There are lots of examples of sectors which are doing well and are priced extremely expensive. Those are not interesting for us. So lending financials, one, insurance companies, life insurance specifically, we find extremely attractive at these levels. Like I was saying, we've increased our exposure to the space. We loved pharma. We found an opportunity. We deployed heavily in Cipla, but the market has moved, and that pharma is now what I'd call more normal valuations. One could buy here, but you're not going to get 20+% type returns, which is what we need. If you need less, you could possibly buy here, right? So pharma, we we love business services. So there's a whole segment of companies which we have ownership in: Quest, SIS, CMS. Um, there's one more which we are about to put on. So four names that we will have on our book, which broadly are defined as business services. And these companies have had a problem in sort of 2 years ago in terms of demand, because half their demand comes from overseas and the demand weakened over there, number one. And number two, rural wage growth is a big component in their price environment. Their pricing power is a multiple of rural wage growth. We're going to see in this next 12 months, rural wage growth be materially higher than the last 2-3 years. So one of their two problems is getting fixed just by the election outcome, in my view. So that remains a strong buy. And the second outcome, which is the weak Western demand, is softening up. So you're seeing the demand of these companies and the revenue growth of these companies already start to increase. So that's another, and valuations remain reasonable. So that's another space which we've got a big investment in. And what else? Yeah, we like hospitals. I spoke about that already. We've put on one new one. We are actually deep in research on another name, a diagnostics name. Could be interesting. That could be something that comes on in the next 3 months. We like natural gas and anything related to natural gas in the country. We think the risk of EVs and in general other forms of energy is overstated. So all forms of gas, on our books, the big beneficiary has been Indraprasth gas. We traded out of it about 6 months ago. It benefited already. We've got Mahanagar gas on our books, which has also rallied hard in this recent period, but still I'd say reasonable and attractive. So gas, things that we've done work on and we think are unattractive. So one which we've continued to speak about is ID services at these valuations is outright unattractive. We thought we would get a chance. We've constantly felt it'll come down. It kind of starts down that road and then bounces back up. So in our view, the opportunity is not there right now. We spent a lot of time this last quarter on auto OEMs because we liked auto comps. We went back to the mothership and studied the auto OEMs in detail. Those are outright expensive. We would call them cells at these prices. So both two-wheelers and, well, all three, two-wheelers, PVs, arguably CVs, are cells. Pharma we took, but we don't think is an opportunity anymore. And then there's that part of the economy which remains super expensive. That is broadly building materials, so cement, capital goods, defense, things that are thematic plays where we stay as far away as possible from those things because they're super, super expensive. So that's a little bit on how we are thinking about market overall and which sectors the work is getting done in, where we are seeing some glimmers of opportunity in an otherwise expensive market. I'm going to pause for a second here, Raghavendra. Maybe you can start with some questions. Maybe you can open it up to the group.
Okay, great. No, thank you. Good overview. And friends, if anyone has question, if you can raise your hand, there's this raise hand. If you click your against, so you can raise your hands at that more tab, and then I can unmute you and you can ask the questions. Team, if you guys have any questions, you can also do the same. So some people are from our product research, wealth managers, anybody has any question, please go ahead. This is an opportunity to ask. But I think Manav, first of all, I think you've done excellently considering the amount of cash that you're holding. And I was just doing a back of the envelope. I think the 6 months return could be bumped up 3% more but it was not for cash actually. So 12% will look like 15%, and 39 will look like more like 30 to 33%. So I think an excellent performance and been very consistent. And I agree actually with your view that the way things are right now, all the opportunities are getting priced in and risks are getting ignored. And this is typically happens when there is such widespread interest in equities, both from retail and institutional. And so I think every time there is some risk which comes on the horizon, we'll see those opportunities like we saw on the election day, where the markets will turn negative, but will quickly also bounce back because the liquidity is so high. And so at least for the next 1.5 year, I think we are going to see that pretty
Very
much.
possible.
Yeah, and because the growth is quite strong, the valuations may sustain. Globally, basically everybody is kind of going into equities like never before. I don't think we have an alternate to a period like this where so much money is flowing into equity markets. And India is also seeing financialization of savings, finally.
Yeah.
For decades, basically, we had 4.5%, money of going into capital markets. Rest everything was in bank fixed deposits and PPF and PF and all that. Finally, we are seeing that that changing dramatically, where nobody wants to now hold fixed deposits. In fact, one of the big challenges for the banking sector is the deposit.
Yes.
And
Yeah.
that's where these banks like HDFC, Axis will score over the others. And that's why it makes sense to hold them in the portfolio. So I think pretty good job from a performance perspective. I right now I think I don't have any specific question from you. This SJS that you have added, basically, what kind of percentage is there in the portfolio? SJS will be what?
So
3%.
the way we do this, Raghavendra, when we add a new name in the small cap piece, or rather in the small cap piece, we never buy more than 5% in a name. In a and if you look at our book, most of the small cap names will be 2.5% of the book. One or two names will be run at 5%, which will be the high conviction names. Current high conviction small cap names is basically just CMS info.
Mhm.
So everything else is sitting at 2.5.
Okay.
And I use 2.5 as a rough number. It could
Yeah.
be 2.75. The idea is it's put on at 2.5.
Yes. Uh, so you currently have 18 stocks in the portfolio. Is there a plan to increase more, broad base it?
The opportunity is less. So you've seen 22 go down, or 23, I think, just 6 months ago, go down to 18 right now. That basically is a function of market opportunity. There's less market opportunity in our view, unequivocally. There have been more exits and less entries. Um, the good news is that there are things like HDFC Bank, life insurance on our books, where our conviction has actually gone up rather than down, and you can scale up the position. So in that sense, the portfolio is a bit more concentrated than it was 6 months ago. If I had to crystal ball gaze, I can see two more names getting added in this next quarter. But then what is more difficult for me to tell you is what we will sell in this next quarter. There are a couple of names which are primed for sale. You need another 10, 20%, and we'll want to sell them. So it could be at 18 to 20, I think, in the near term.
And one, I think people, I'm sure they will have it in their minds. So let me just put that. Let's say, there is a big correction. Let's say there is a 10-15% correction in the market. Okay.
Right.
And how do you see your portfolio doing in that?
So maybe sometimes the best way is to answer it in what has actually happened, right? Um, so election day, very recent example, should be a good way to stress test people's portfolio.
Yeah.
I said Sensex went, let me give you, I have it somewhere as exact numbers. Yeah. Sensex went down 5.7% on 4th June 24.
Yeah.
Capital goods index, as an example of the aggressive part of the portfolios that people have, went down 12.1% on 4th June. Relative to this, our portfolio went down 3.6%.
Okay. Yeah.
Of Sensex.
Yeah.
That's a one-day reaction. Let's talk about a broader period which we've seen in the recent past, which was October 21 to June 22. October 21, you remember, was the first peak of the Sensex after,
Yeah.
broadly speaking.
Yeah.
And from there, all the way down to June 22, between uh, India issues and global interest rate issues, the market came down. The market came down in that period 10.6%. Sensex was down 10.6%. Capital goods, again, using that as an example of aggressive things, came down 20%. So 10.6, double of that was aggressives. How did we do? 6.7%. Actually, surprisingly, exactly the same number, 63% participation on the way down. So I would like to believe that we will be repeating that sort of a performance, which is meaningfully below the market risk is what the portfolio represents, not just in the cash, not just for the fact that we have cash, but also the portfolio construction is built with very few aggressive things.
Yeah.
We see an environment like this as a good reason to stay away from aggressive things. And at least on a portfolio level, we consider it a conservative portfolio, right? You can take some of our names and say, this is not conservative. I would agree with that. Some of our names are not conservative.
Yeah.
But at a portfolio level, I would say our positioning is conservative. That is reflected in what I think you will call down capture ratio,
Yeah.
which is when the market reacts badly, how do you behave? I think the other question which may be in people's minds is, okay, you're a conservative portfolio, but do you make money for me when the market makes money for me? And that I think in your parlance would be called up capture ratio. I've got that data. I was expecting a question around this, which is why I have it ready. Um, in So let's just call March 20 as COVID, and performance from March 20 to October 21 when it peaked, as moved from bottom to peak. Our performance was 151% of Sensex. So our up capture ratio was 151%. So we outperformed the Sensex on the way up. And in this recent period, so June 22 was the last low, and from there it's been a one-way market. In that period also, our up capture ratio has been 154%, very similar to the 151 up capture in the earlier period. What this is, however, disguising is that in the last period of the up move, the last few months, we underperformed in the
Yes.
last one and in this one. In this one, we've been flat. If I look at September last year, when we started turning cautious and saying valuations are now high, started repositioning the portfolio. Since then, we have been at Sensex level. Sensex has given 20% return since then. We've had 38% average cash since then, but we have given 22%. So it's been at Sensex levels. If I go to the last bit of the previous phase, we actually underperformed. So the 22% that the last phase was, we gave 16, 17. We underperformed by 5, 6%. But if you take the whole period, which is the whole up phase, we substantially outperformed by more than 50% in both instances. So we're trying very much to create a portfolio where risks are below market and returns are higher than market. And investing yesterday is yesterday. In yesterday's, we have been able to achieve this. We think we have created a portfolio to achieve it even for tomorrow. You will see the results.
That's true. Good. No further questions from me, guys. Anybody has any question? Please, you can ask. You can also put your question in the chat box. Okay, there's one question. Ankit, do you see any factor that can lead to reduction in domestic flows? What will be the major triggers for corrections? What possibly could be a trigger for correction, let's say?
I'll tell you the risks in the market and then talk a little bit about what I call retail participation. Risks in the market, one now is coalition politics is going to be noisier than the one-party rule that we had in this last decade. So expect a bit of noise, expect those to be buying opportunities if you get them, number one. Unless there's a bigger risk that comes into play, which is an outright breakdown of the political process. Number one. Number two, you've got global macro risk still, which is not low, coming from the US, let's call it market environment. Some of the data is a bit two-way data right now in terms of employment and inflation. But some of the gurus of that market put probability of recession in next 12 months at greater than 50%. And we have many exporting sectors which depend on that, which there is a risk out there. If you have election noise in the West, both in Europe and in US, where there is a move to the right, in France's case, you've already seen the first phase of the voting, give Le Pen the mantle. If Trump comes, that will be a move to the right. And if anti-immigration, anti-goods import, anti-services import becomes a bigger issue in this next 12 months as political rhetoric in the West, that is a negative for a services exporting country, which is India, possibly trying to become a goods exporting country, that is India. So those are all risks, which I'd call broadly macro risks. The macro opportunity is interest rates in the near term but we depend very much on the US interest rate cycle to be able to move our own interest rates. If we move them out of sync, there will be capital outflow, rupee will get hurt. So it's kind of catch 21, right? So it's unlikely that we will move too much out of sync with US interest rates. So, but I still see that as more of an opportunity rather than a risk. Those are what I'd call visible macro risks. In terms of micro, actually, there are many sectors that are doing well. The main micro risk is just that of valuation, right? If I had to pick one big topic, there is overvaluation in many sectors. So now, back to your original question, what will make retail or equity participation by domestic market take a pause? I think I'll make 2 points here. One is that if you look at the SIP data, when the markets have crashed or corrected by more than 15-20%, the SIP data was still one way.
Yep.
In which the correction took place. So let us not somehow in our minds take that straight line, which is the SIP inflow, meaning that the market is one way. Despite that flow, the rest of the flows turn negative, which takes the market down. So that's the first point. The second point I'll make is that retail participation has, in every bull market, there's been good reasons to believe it will continue forever. In this current environment, the reasons to believe it will continue forever is financialization of savings is happening. There is more electronic trading, which has made ease of trading easier. There is more ETFs, which has made ease of participation easier. But there have been good reasons in every upmarket. In my mind, it is nothing but retail market chasing past returns. If past returns turn flat to negative retail participation, and they do so for more than 12 months, retail participation will abate. If retail participation abates, then that actually causes further market risk. So I think if you have a trigger, which is somewhat any of the things I spoke of, or any of the things that none of us have even thought about yet, and that impacts risk ability in the market, it will be a compounded downward impact because you've got too much retail participation, which will become too little retail participation at that period. So you're going to see choppy markets is the outcome.
Yeah, Mr. Tushar Mehta, do you have a question? Yeah.
Thank you. Thank you, Raghavendra, first for Ladderup to arrange this call. Much appreciated. And thank you, Manav, for being patient and taking all the points in macro environment. And also you highlighted a few micros also, which are important from an investor's point of view. I wanted to understand two, 3 points. One, what is the strategy of your AIF? Do you go on the growth-based stocks or value-based stocks? That's important. Number two, how much time period you keep, or you think that if the percentage what you desire, say 20%, the material has already gone up, then you will try to churn it up, or there is one fixed time period whereby you hold and you wait for that. And one clarity is very clear, which you gave was what is attractive, what is not attractive. So that shows very clear mindset on what you and AIF is functioning on. That gives us a very good insight towards it. Thank you.
Thanks,
All right.
Tushar.
Thank you, Mr. Mehta. I noted down those points. So I won't talk about sectors which we find attractive. I've talked about it. I'll talk about the first two, growth versus value and time frame. And I'll address the time frame question a bit differently. Growth versus value. We try and stay away from this debate, to be honest. We think a country like India is primarily a growth-driven investment country. Like 80% of the things that we have bought would have been called growth names. There have been periods when we've bought things like NTPC, ITC, etc., which would have been called value. But even those value things are super expensive now, so that value is not value anymore, right? So the first point I'll make is India as a basket of equity opportunity is significantly skewed towards growth opportunities. We don't take a view on whether we like growth or value as part of our thought process. Instead, we say relative to its fair value, given its ability to grow, is it cheap or expensive? So NTPC was cheap for us at 80 rupees when book value was 160, 150. NTPC, the same value stock, is a stay away from when it is 300 plus. Coal India was a value stock, which was very attractive to us. And now it is a stay away from stock. ITC was very attractive to us. And now also for the point on tax that I made earlier, it's a stay away stock. So we've owned these value names and we now think they're absolutely not value. Similarly, you've got on our book now things like Yatharth, which I'd call growth. We've had, but at a reasonable price. So GARP, growth at reasonable price, is a very decent chunk of what we buy. If I had to try and say this overall strategy, which we define as buying undervalued companies as a sort of, that's the real thing that we are doing in our business. If I had to further break that down into 5 different things that we do, it would be number 1, GARP, growth at reasonable price. Examples today, Yatharth. Examples in the past, Equitas. Examples in the past, Aster. PNB Housing now are called GARP, growth at reasonable price. We do cheap relative to self, where we take a view that nothing much has changed. People are overreacting. HDFC Bank is a good example. So it used to trade at 22 times earnings. It's trading at 16, 17, 18. It's an opportunity. Cheap relative to sector, things that relative to its sectoral position, for example, Axis versus HDFC Bank. If HDFC is 22, should be 22, then Axis should be 17, 18. And if it's 13, we'll buy it. So cheap relative to self. Contrarian, before I get to contrarian, cyclical investing, examples, IOC, examples, Castrol, things that are on the wrong end of the cycle. So things that are disbenefiting from the cycle, we'll buy then, and then we'll sell when either the cycle normalizes or becomes more than normal, above normal. And then finally, contrarian investing, where market is taking a very, very negative view on something, we will study it, and if our view is different, we'll buy it. But in that contrarian investing, it requires many months of work, because we like to do private equity style work on the ground to convince ourselves that it's not just in our minds that we think we're contrarians. We've got some real work to back up that we're contrarian. Sometimes that means while we're working, the price goes away. It's just, hazard of our job. So that's what I would call our strategy. We don't obsess over the value versus growth point. I'm not sure it perfectly answers your question, but that's my best shot at it. Second point was on time frame. We underwrite. What I mean by underwrite is when we are studying a name, we say we will hold something for 3 years. That is our thought process when we underwrite. So, as an example, we think that HDFC Bank is going to be 125 rupees EPS in 3 years from now, and its fair price is 22 times that, and that has a price outcome. It's 24 to 2900, depending on the price to earnings that we get. We do a discount backwards to today's price, and we're looking for, in a large cap, 20%, in a small cap, 25% return potential before we buy, with a 3-year view. Now, then comes in reality, which I'll call Mr. Market. Mr. Market might trade the name up in 1 day. It may trade the name up in 5 years. So we're constantly monitoring that. And has it become expensive? For example, if you made HDFC Bank 2,500 today, then its remaining potential to get to my high case of 2,900 means that I'll only earn 7-8% for the remaining 3 years. So I'll probably sell it at 2,500. So I have to react to what the market is doing. Within that, I'd add one further constraint that we have to live with, which is we don't sell anything before 1 year, 1 day for tax reasons. So sometimes, a good example was IOC recently. The move was very sharp from, I think, 100, 110 to 170. It was a one-way. Within 3 months, it was achieved. 150 was our exit price. So we had been buying over a 2-year period. Then we sold whatever was 1 year, 1 day plus, which was 70% of our holdings, but 30%, which was less than 1 year, 1 day, we had to wait till it became 1 year, 1 day to sell. So minimum 1 year, 1 day, maximum as long as it takes, but with a view that we are holders for 3 years. I don't know if that again addresses your time frame question. I think does.
Yes. Any other question, friends? If anyone has any question, please raise your hand or type it in the. Okay, Naveen. Yeah, you had raised hand earlier also, I thought. Yeah, Naveen. Hi. How are you doing? You'll have to unmute yourself.
Yeah, can you hear me?
Yes, yes.
So my question is, how do you see the technology sector to perform because it is not underperforming since last 1 years? Do you think that within 1 year or 2 years, technology sector will move? We have opportunity in this technology sector?
Naveen, I think you mean IT services more specifically within technology. Is that right?
Yeah.
Okay. So IT services. Now, IT services, I'm just going to take Infosys as a benchmark of the sector it broadly is. About 2 years ago, Infosys was 1,900 stock price. That at that point meant about 38, 39 times price to earnings 1 year forward, which was higher than it has been since 2000, which is 22 years ago at that point. We were shouting to everyone that please stay away from IT services. Our purchase price, are using the logic I did, which is 3 years hold period, what is the fair multiple, etc., was about 1,100 then. Stock price was 1,900. We were saying we are buyers at 1,100. Market was obviously laughing at us and saying you're crazy, right? As it turned out, that sharply corrected, and I think for a very brief period entered 1200 territory. We were very, very tempted to put on a little bit, and then very quickly moved up to 1500, which is broadly where it has been since then. Moves up and down around 1500. At 1500, if our exit price 3 years forward right now is about 1900, right? So Naveen, if you hold for 3 years, you'll make money, but you'll make a low IRR. We don't like making low IRRs. We'd prefer to earn 6.5%, 7% in FDs instead.
Yeah.
You make 6, 7% only, by the way. Maybe you'll make 9, 10, but you'll take equity risk for making that 9, 10. We don't like to do that. So if it becomes, so that 1100 buy price 2 years ago is about 1250, 1260 now, right? If Infosys became 1250, we would put somewhere between 10 and 20% of the fund in IT services. I'm assuming the rest of the IT services pack would also have moved, right? So what I'm saying to you is it is a low return space from this current level. If you want higher returns, you have to buy it cheaper.
What again? Stay away.
It is a low return space from this level, but it's also reasonably low risk. We like that same risk profile, but a bit more margin of safety, margin of return, ability to provide return, which is why our entry price for that 20% return that we're trying to generate across the book is 1250. So I don't see you losing money, but I see you making low returns. That's my view.
No, that's right.
Great. Thanks, Naveen. So I don't think there are any further questions to Manav. So I think thank you so much for doing this. Let's do it more often. I think this call is happening after 5, 6 months. Next time.
No, that's true. I would love to do one every quarter just to keep
Yeah.
all our Ladderup clients, updated. Would love to do that. We landed up doing this 2 weeks more precisely before our quarterly newsletters is issued. So unfortunately, now you're going to read all the same points 2 weeks later again. But you have a preview of what's coming to your inbox 2 weeks from now.
Great. Thank you so much, Manav, for taking time out here. And thanks everyone for joining in today. If you have any questions, let us know and we'll be happy to get that answered from Manav.
Yeah, I'll just finish with one last point. I don't think Shweta's face came on, but about 6 months ago, Shweta joined our team to help on fundraising. She's probably already interacted with some of the clients and definitely interacted with the Ladderup team. Feel free to reach out through her. We try to be as responsive as possible.
Yes, definitely. Okay, great. Thanks, Manav. Bye-bye.
Thank you.